Okay, so chapter 10, and I'm starting on page 396. 396 and 397. So this chapter is about plant assets, and we're going to get into how to cost for plant assets, how to um, look at depreciation methods, how to use and calculate those methods properly. First, we want to talk about what is a plant asset. When you hear plant asset, what do you think? You already know what an asset is, but what do you think a plant asset is?
Like depreciation, disposals.
More so in terms, what do you know of an asset? What is an asset? Because you learned that in financial accounting 1. Something you own, right? Building. And when we say plant assets, what we mean is something that lasts for a very long time, well beyond 12 months, well beyond 1 year. So certain plant assets that you have are, yes, a building, land. What else do you think? Cash is definitely not one of them, right? Because cash is an asset that doesn't have a useful life past what? Past 1 year, right? Don't you use cash interchangeably with everything? It comes in and it goes out just as quick as it comes in, right? But with a building, once you get a building, how long do you own that building for? Years until you sell it. So some aspects about plant assets that you need to know. Tangible in nature. In other words, that means that you can physically touch plant assets. You can physically touch a building, right? You can physically touch land. You can physically touch a vehicle, right? Actively used in operations. With a building, you purchase a building so that you can do what? Use it for operations, right? Same thing with land. Expected to benefit in future periods. Plant assets is another word for fixed assets. Is also another word for long-term assets. Okay, so when we say those things, expected to benefit in future periods, it means we're purchasing a building today that is going to be worth more in 10 years. Does that make sense? We're purchasing land today that's going to have a value more value in the next 10 years. Generally, we can also call it PPE, or property, plant, and equipment. Equipment is also a very well-known plant asset. Why? Because it's going to last beyond how long? 1 year, and also it's going to be used for future benefits and operations, and it also can be what? Tangible or touch. So 3 factors that you have to be concerned about with assets are: one, the acquisition, meaning how much did you pay for the asset. 2, what is it going to be used for? Is it going to be used and costs will be allocated to periods going forward, or is it going to be used frequently? Is it going to be expended frequently? Disposal. Assets don't last forever. Buildings don't. All that stuff uses or loses value. So eventually it will have to be disposed of. Cost determination. So when we talk about acquisition, you're concerned about the purchase price of the asset. But those are not the only costs that go into acquisition. What else goes into acquisition? Whatever you pay for that is going to add to that asset to make it available for use is what you consider to be a part of the acquisition cost. So what do we mean by that? If you were purchasing a building, what else do you think you're going to have to pay for along with that building? Not quite. Let's just focus on the outside of it.
Security.
No. Like the Dixie? Who sold you the building? Who made it possible so that you could get the building? No. A realtor, right? And don't they work off of commission? That cost will be included in acquisition. Any debt that was owed on that building is included in acquisition because now that you own it, you have to pay it. Any licenses that you have to maintain to get this building, those are also included in acquisition costs. So whatever cost added to that asset and made it available to be used, meaning in order for you to get that building up and running on the inside, right? Whatever cost that it included to do that have to be included in acquisition. The only thing that it excludes is what? Financing charges. So in other words, if you purchase the building with financing, some type of loan or something like that, those things would not be included in acquisition. So they give you an example here. Land is not depreciable, and we'll talk about that in a minute. But land is a plant asset, and look at all the costs that were included in acquisition. Insurance premiums, the initial purchase price, the real estate agent that sold it, their commissions, the title search and transfer fees of that land because somebody owned it before you, any delinquent taxes, and any surveying fees to make sure that the land is available to be used. All of those costs went into acquisition. Now, why do we say land is not depreciable? I won't say land don't lose value, because it does. But the reason why it's not depreciable, because yes, it can be continued to be used over and over and over and over and over again. If it was a building on it, you could easily knock that building down and put something else there. Right? All right, land improvements. This is normally the things that people don't really think about. When you buy land, it's just not buying land, I'm going to build something on it. If you are running a business and you're building your business around this land that you have purchased, some other things that you have to be concerned about are the parking lots that are needed, the driveways, the fences, the walks, the shrubs, lighting systems, all that other stuff that makes sure that the land is what? Functional, right? Ready to be used. So those land improvements we can depreciate. We can't depreciate the land itself, but we can depreciate the things that we do to the land, because we know if we build a pavement, eventually that cement will do what? Crumble. And we'll have to do what? Exactly. Buildings. These are depreciable. Cost, purchase. These are all the things that are included in the acquisition of a building. Cost of it, or if you had to construct that building from the bare bones, that's a part of the acquisition. Brokerage fees for the person who obviously negotiated those contracts, taxes on any of the building if they existed prior to you purchasing, title fees and attorney fees, right? Machinery and equipment. This is the stuff that goes on the inside, right? Purchase price, installing and assembling and testing it before it's being used. The taxes on that equipment from the purchase. Transportation charges, meaning those charges to get the equipment from wherever you purchased it from to wherever it's going to be used. Insurance while in transit. The reason for that is you could purchase the equipment down the street, it could drop off the truck somewhere within the shipment, and if you don't have insurance on it, what happens? You just wasted money. So lump sum purchase. What do we mean by lump sum purchase?
Purchase that you pay all at once.
Right. It may be a deal where a seller will say, you can't buy this building without also purchasing the land, or you can't buy this land without allowing this building that's on the end of the corner. So they have to lump sum that into one purchase, right? Like this example that they gave you, CarMax paid $90,000 cash to acquire a group of items consisting of land appraised at $30,000, improvements appraised at $10,000, building appraised at $60,000 for a total of $90,000. It says the cost will be allocated on the basis of appraised value. So appraised value is not necessarily the actual cost, right? What is it? It says it up there in blue. Market value. Relative market value. So in other words, what would it be worth on the market? Just like how we do a car, right? A car loses value from the time that it drives off the lot. The same thing here. With these different things, they've all appraised at that at 100,000, even though we know we paid how much? 90. We only paid 90, but it appraised at 10,000 over what was paid. So what they're saying is percent of total. We know that it's worth 100,000. 30,000 of that 100,000 is 30%, and the apportion cost is basically you taking that full 90,000 that we paid for all three items and multiplying by its percent to get the apportion. Now, what do we mean by apportion cost? Just by looking at that, you don't even need to know a definition. What do we mean by apportion cost?
How much that basically that food costs are paying unless we spend 10,000 out of 100,000.
Exactly. So in other words, we know it was worth 100,000. We paid 90 for it. We want to know where that 90 truly came from. How we apportion those costs as opposed to that 100,000. Depreciation. Now this is the most important. First of all, what is depreciation? Loss of life.
The value of usefulness.
How much it has been used. I don't want you to say loss of value because that's not what depreciation is. Depreciation is not necessarily loss of value. Assets are purchased, assets are put in place so that they may be used. So at the end of the year, you depreciate for what has been used of that asset. Not, oh, it lost this much value. No, that's not the case. So when we acquire the assets, the cost that we pay, we have to allocate that as expenses or depreciation expense, okay? Because most assets, plant assets, do depreciate. So factors in computing depreciation. First thing is the cost. How much did we pay for the asset? Second thing is salvage value. What do I mean by salvage value?
Total amount of the depreciation.
Not amount of depreciation, but what is left after you have used its useful amount. What is left, and then useful life is the number of years that it expects to be in use, and that is truly an estimate. So you got three different depreciation methods. We got straight line, units of production, and decline and balance. We're going to go through each one of them. Most of them are similar, but with cost, salvage value, one thing I don't want you to think is that an asset will always have salvage value, because not all assets do, okay? But cost, salvage value, depreciable cost. Useful life, the number of accounting periods. If we were doing units of production, the useful life would be the amount of units that are inspected. So starting with straight line. This is the equation. It's also in your book. Straight line, cost minus salvage divided by useful life, or useful number of years. And that's going to show you how much you're going to depreciate. Now, the good thing about straight line is it's the most basic. That's one. Second, straight line allows a company to depreciate the same amount every single year for the entire useful life. Okay? And third, this is also a slower way of depreciating over time. Because if you're doing the same amount for however many useful years, then that means that you're going to try to get as much out of that depreciation as possible over that useful number of years. So in this example, the cost was 10,000 of this asset, salvage value of 1,000. How many useful years? 5 years. So that came out to about 1,800 per year. And this down here, this journal entry is just showing us recording annual depreciation by debiting depreciation expense and crediting accumulated depreciation. Now, how many of you have heard of accumulated depreciation? Do you know what it is? Do you remember from Financial Accounting 1 contra asset? Okay, so what that means is every time you depreciate, On a balance sheet, you will see the actual asset, like say if it's equipment, in this case it's machinery. Let's use that. You're gonna see machinery, and under it, you're gonna see accumulated depreciation / machinery. All that means is that we expensed the depreciation for that particular asset, and we showed how much we accumulated in depreciation for the year. Okay? So anytime you're doing depreciation, if you don't see an accumulated depreciation account, that's something is wrong. It always has to be there. Secondly, here with the 1800, and I think, yeah, just go here. Because that 1800 was accumulated, you have to always take what has been accumulated and subtract it from the beginning book value. So in that particular example, the beginning book value for that asset was how much? 10,000. So now we really should be doing what? 10,000 minus
Minus the salvage value, 1,000.
not salvage value, because we
We did the meter, the 1800.
yeah. So you had, and they're doing it here. They're just doing it for 2 periods, but your 10,000 minus that first year of 1800 accumulated depreciation, right, is going to give you a new book value of how much? What's the new book value? Somebody has a calculator. You can do it in your head. It doesn't matter. How much? 8,200. All right. So now this 8,200. Every year after that, you're going to subtract what? 1,800.
So if I want to try to resell it or something like that, I have to sell it at 8,200, right?
If you're selling it that year, and that's how much it's worth, yes. Now, with that being said, what happens when you do a different method? Does it?
Mm-hmm.
Does the cost actually change? See, this is what I was talking about. Notice how the depreciation periods, the first year, obviously there's no depreciation. This is the year that you bought it in 2012, right? 2013, first year, what is going on? It's not what I wanted to do. All right, so second year, 2013, the cost went from 10,000 to 9,000 because of what? The salvage. And then they subtracted the 1,800 again, and now book value is how much? The 8,200, right? So they're continuing to do the same depreciation every single year, which is a good thing about straight line. And then here, for accumulated depreciation, they're just doing 1,800 plus 1,800 plus 1,800 plus 1,800 plus 1,800. So still building back up. Now, when you're done by that last year, what should you get back to? Which was the salvage value. That's the whole point of straight line. Units of production is dealing with totally different factors, because units of production, I'm sorry, let me just, okay. Units of production is dealing with units that are being produced, right? With straight line, we were dealing with some just one plant asset and the cost. But with units of production, cost minus salvage divided by what? So instead of useful life, it's just the amount of units that are being produced, right? And then step 2 of that, because this is going to give you the depreciation per unit. Then you're going to take that depreciation per unit and multiply by the actual number of units that were being produced in the period. So this example, 7,000 units were inspected, right? And salvage value was 1,000, cost was 10,000, so that means depreciable cost is actually 9,000. And we're going to divide that by how many units? It says units inspected were how much? 36,000. So we divide our depreciable cost by the 36,000 to get 25 cents per unit. Taking step 2, our 25 cents per unit times 7,000 units that were inspected during 2013, and that gives us a depreciation expense of $17.50. Now, don't worry if it doesn't make sense. It's fine. We're going to do some problems after this, so it will make sense. Units of production depreciation schedule. Again, same situation. First year, no depreciation. Second year, the depreciation was worth how much? The asset was worth how much? Number of units inspected or produced, 7,000 times 25 cents, 17.50. Subtract that from 10,000. Now we're down to 82.50. Second year, number of units actually produced, 8,000 times 25 cents. Depreciation has went up to 2,000, which means that our book value has come down to 62.50. Double declining. This one is similar to straight line because it uses straight line within it, but I'll tell you the benefits of double declining in a minute. Double declining has 3 steps. First step, 100% divided by the useful life or number of years, right? So that example they give you 100% divided by 5 years useful life gives you 20%. That 20% is the straight rate, okay? 20% is the straight depreciation rate. Step 2, you're going to take 2 and multiply it by that what? That straight line rate, right? That 20%, and that's going to give you the double declining rate, which is 40%. And then step 3, you're going to take that 40% or that double declining rate and multiply it by the beginning book value to get your amount of depreciation. Now, seeing that and knowing what you know now of straight line depreciation, what is the benefit of doing double declining over straight line depreciation? It's called accelerated, okay? So people who choose to do double declining balance, that means that they want to double or accelerate their depreciation every single year, which is generally going to make the asset depreciate way before what? Its useful life, right? Because if you're doing it this way, you'll probably end depreciation by year 3. And it has a useful life of how long? 5 years. So you might be left with a considerable amount of salvage by that time. So this depreciation chart looks totally different from the others because it's a more accelerated rate. Started off with a book value of 10,000. We know the double declining rate is 40%. 10,000 times 40%, depreciation of 4,000. Now that asset is only worth how much in 2013? 6,000. 2014, 6,000 times that 40%, 2,400 for depreciation expense. Now the asset is only worth how much? 3,600. All the way down to 2017, which is the last year. How much do they have left? Back to the salvage, right? But notice the little star. It says year 2017 depreciation is 1,296 minus that salvage, right? 296. Never depreciate book value below salvage value. That's important. So if you get to a point to where your depreciation is rendering for that book value lower than the salvage value amount, then you're not supposed to do it. At that point, you got to let it stay where it is. So in this case, it was only worth $1,296. Salvage value is 1,000, and last year we cannot depreciate.
The double decline is like, is you supposed to use that as purchase? And then to say that their assets is not as high as the government is for, did they drop it?
No,
What is it, why do people use double?
they probably cheating the government.
That's what, no, we never.
It doesn't matter to the government what method you use. They don't care about that. Hopefully what they anticipate is that people will depreciate, or businesses, we should say, not people. You as an individual should not be claiming depreciation on your taxes, that's one. Two, as a business, claiming depreciation. Their hopes is that whatever method that you choose, just know that that is going to factor into your adjusted gross income
Right.
for the year. But some people are naive and feel that, oh, claiming depreciation is going to lower that. No, if you're in business, that is not a factor. It doesn't necessarily lower your AGI or your income for the year. It can be expensed, but that's about as far as that goes. And yes, the government will flag it if it looks.
If you got a high expense and a lower API.
No, because some businesses claim losses every year
Yeah.
because they're just not functioning properly, or they get most of their profits towards the beginning of the year instead of at the end of the year. It's different scenarios, but the government is smart enough to know that if you only had one piece of equipment for your business and you're claiming that it depreciated $100,000, they not, naive with that. They know better. So you got to use discretion when it comes to that. So comparing depreciation methods. All those examples we used, they were all 5 years long, right? Straight line was the same amount every single year, still came out to the same amount of depreciation. Units of production was not the same every year. It started off low, went up, and came back down, right? Still same amount of depreciation. Double declining started off very high and went all the way down as far as it could go, right? Still same amount of depreciation. So I'm saying that to say it doesn't matter which method you use. To your point, businesses might choose to do high. Good. No.
No.
What room did they tell you to go to?
This way.
Okay. Miss Johnson, you talking about Maria Johnson, the English teacher?
Uh-huh.
I can't imagine she would have class on this hall, but you can check down here around the corner past the bathroom.
Okay, thank you.
Uh-huh. Okay, so most method used by company straight line. The point I was trying to make was people who want to claim more of an expense the first 2 or 3 years of business may do double declining because you're going to depreciate the most in those first couple of years. Those who could care less about how much it depreciates, just wants to expense it, they may choose to use straight line. Okay, and only businesses that are like manufacturers will use units of production because they're producing product.
Like clothes and shoes and cars.
If they're the manufacturer, yeah, like piece by piece. And that just talks about the system that the IRS uses to depreciate options you can do. Now, sometimes there will be circumstances where you will have to depreciate for part of the year. In other words, you didn't purchase that asset January 1st. You probably purchased it April or May or whatever. So you can only depreciate for how many months it has been used. In this particular example, the cost of this was $10,000, salvage value still $1,000, depreciable cost $9,000, accounting period is 5 years. It says assume the machine was purchased October 8th. So that means how many months have passed? When did they purchase it?
October.
So how many months are you going to depreciate for? 3 months. October, November, and December, right? Okay, so 10,000 minus the 1,000 divided by the useful amount of years, which is 5 years, and then multiplied by those 3 months over 12 is going to give you the partial year depreciation. Everybody has that, right? So disposal of assets. You know how I told you assets don't last forever, right? And eventually you will need to dispose of them. Let me go back. Go to page 406 and 407 in your book. So we need to talk about additional expenditures. So in addition to normal expenditures that you have, you also have repairs and everything that have to be made, right, for things to continue to function. First, we got ordinary repairs. What are we talking about when we say ordinary repairs?
Are those like the
Keep the, item in good condition.
like the basic
Yeah,
routine
basic
stuff,
stuff
or
that
just purely?
Okay, so look at this chart up here. Ordinary repairs maintains normal operating conditions, right?
Right.
So if we're just talking about equipment, that means that we're gonna make repairs to it to make sure that it's gonna constantly operate, right? Does not increase what? Productivity. So in other words, if it was only producing 10 items
It's still
an hour, it's still gonna do 10 items. Does not extend life beyond original estimate. So if it was 5 years useful life, it's gonna stay 5 years useful life, even if you make an ordinary repair. Betterments and extraordinary repairs. What is that?
We added stuff to it,
Yeah, to make it go on.
to make it produce faster.
Yeah.
So let's use an example. The best example to use is probably a vehicle, right? So an ordinary repair for a vehicle is going to be what?
Changing my
Oil
oil.
change.
Your oil changes,
Tires.
filters,
Well,
Tires.
Yeah.
tires, yeah, because it's just a normal wear and tear type of situation, right?
Right.
Brakes, maybe it's something that
Right.
you do, tune-ups, things of that nature, right? Okay, what about a betterment or an extraordinary repair?
Especially transmission.
Transmission, engine, gaskets,
Right.
those types of things are extraordinary. Those are going to make the car run
That's the
longer. I don't know about faster, longer, right? It's going to extend their useful life. Now, the type of expenditure it is, revenue for ordinary repairs and capital expenditure for betterment or extraordinary repairs. Okay, finally, disposal. If you're going to dispose of an asset, you got 3 things you can do. You're either going to sell it at its book value, meaning you didn't make more money or you didn't make less. You're going to sell it below its book value, or you're going to sell it above its book value, right? So this is the example that you have to use. If the cash is greater than the what? The book value, then that means that you have a gain. If the cash is less than the book value, that means that you have a loss. And if the cash equals book value, there was no gain or no loss, you just broke even, right?
Right.
So what they're saying here is if cash is greater than book value, then that means that you're going to record obviously a debit to cash because you received cash for it, right? You're going to credit what? If you're making a gain and you're selling it above book value, you're going to debit cash because you received cash. And what else did you receive? It's in your book. I'm on page 408 and 409.
Accumulated depreciation.
Yes. You're also going to credit gain on disposal of that asset and also record a credit to that particular equipment or that asset or whatever it is, okay? If you sell it at book value, that means you didn't have a gain or a loss. You're going to debit cash, right, because you did receive money for it, and you're going to credit what?
Accumulated depreciation.
At book value? The asset, whatever the asset is. And you're going to debit accumulated depreciation. Accumulated depreciation is debited no matter what, whether you sell it above, below, or at book value. Okay? Now, if you sell it below book value, Cash is still debited, right? But instead of you recording a gain on the credit side, you're gonna record a what?
Loss on the debit.
Loss on the debit side. And also accumulated depreciation will be debited, and you're gonna credit whatever the asset is. So this is an example. Discarding a plant asset. The machine cost $9,000. Accumulated depreciation of $9,000. Previous year was discarded on June 5th of the current year. So they're gonna depreciate that equipment using straight line over 8 years with zero salvage value. If we had to calculate that out, the machine costs $9,000, no salvage value means there's nothing for us to subtract. And when you divide that by 8 years, what's the depreciation you get? Calculate it.
$11.25 a year.
$11.25 a year. So what they're trying to show you here is that even though it's $11.25 a year, what was the accumulated depreciation amount? $9,000. So that's the full, how much? That's the full amount worth of what? That's if the depreciation was just fully depreciated for that machine by the 8th year. This second example, the machine cost $8,000. The accumulated depreciation was less than the cost, right? And still no salvage value, still 8 years useful life. The depreciation expense is partial year. When did they say they purchased it? Or when did they discard it? I should say that.
July 1st.
July 1st. How many months have passed since July 1st? 6 months. So 1,000, which is what? What's the 1,000?
The depreciation.
And then multiplying that by 6 over what? 12 gave us the partial to bring the depreciation up to the date that we're discarding it, and to record the actual discard of the asset. Loss on the disposal was $1,500. How did we know we had a loss? The depreciation. 500 here to bring it up to date, right? Plus the 6,000 that was already accumulated on it. That's a total of 6,500, right? And then they had to discard it for how much? The 1,500 was the remaining book value. Remember that whole, oh, you can't depreciate past an amount that's lower than what? Salvage. They said zero salvage because there's nothing else to salvage out of that. But 1,500 is the amount that it was discarded for. So they lost that amount. How much was it worth at the date that they discarded it? That's what you paid for it. How much was it worth when everything was said and done? Selling assets. March 31st, this company sells this equipment. It cost $16,000, had accumulated depreciation of $12,000, annual depreciation of $4,000, but they sold it for how much? $3,000. So to record the depreciation expense, their annual was $4,000, right? But when did they sell this? What month? They didn't sell it on December 31st. March 31st. So how many months have passed? 3 months. 4,000 times 3 over 12 gives them a partial depreciation of how much? 1,000. That's what y'all see up there. And then to record the sale of it, how much did they sell it for?
2,000.
How much was the accumulated depreciation? How much did we pay for it? So when you subtract the accumulated depreciation of 13,000, which is the 12,000 plus the 1,000, and subtract that from what we originally paid, which was 16,000. How much are we left with? 3,000, which is what we received for it. So we debit cash 3,000. We debit accumulated depreciation of 13,000, which is at 12,000 plus 1,000, and of course credit equipment for the full amount of 16,000. So that means there was no gain or what? Loss. In this case, we paid 16,000. It still depreciated 13,000, but now it has been sold for how much? 2,500. And so we know that it was worth how much? How much was it worth as of the date that we sold it? It was worth 3,000, but we only received 2,500 from it. So we record debit to cash for what we received. We record the loss that we incurred, which was $500. We record the accumulated depreciation of 13,000, which was 12,000 plus the 1,000, and we record a credit to equipment for the full amount that we originally paid. Okay, go to the section in your book, and I believe it's page 411. Intangible assets. No, I'm wrong. 410. 410, sorry. 410, natural resources. So there is a thing called, the same way that we're talking about depreciation, there is also depletion. Okay? Depletion is only dealing with natural resources. So when we say depleted, what does that mean? What are they saying in the book? Depreciation is the process of us allocating costs based on what? How much the asset has been used or consumed, right? So with natural resources, it's the same concept, different word. Instead of depreciation, it's depletion, meaning how much natural resources have we actually what? Consumed. So the process or natural resources, what we're talking about, oil, coal, gold, minerals, right? With depletion, it's still cost minus salvage divided by what? Units of capacity. So the actual amount of units that are estimated, right? And then the second step of depletion is taking that depletion per unit and multiplying it by the actual units that have been extracted and sold. So in this case, they estimated 250,000 tons were available, and it was purchased for 500,000, no salvage value. So 500,000 divided by that 250,000 tons gives us $2 per ton. And we're going to take that $2,000 per ton and multiply it by the units extracted, which they didn't tell you that in that little paragraph up there, but it's 85,000 tons, and we're going to get 170,000 in depreciation. So this is how they show you how that depletion, I say depreciation, depletion is recorded. You got a debit to depletion expense for 170,000, and then a credit to what? Accumulated depletion, mineral deposit, 170,000, and then we also have to subtract that from the beginning book value. The value of that mineral deposit was 500,000, less our accumulated depreciation of depletion of 170,000 gives us a new book value of what? 330,000. Intangible. So you know how before I was saying plant assets are tangible, meaning they can be what? Seen, touched, right? Intangibles are the opposite. You cannot touch them. You cannot see them. It is a matter of knowing that it exists. So what they are considered to be are assets that are not a physical substance, meaning you can't see or touch them, right? But you know that they exist. Their useful life is going to be different for each one that we're going to talk about. All of them have a different useful life. The premise around intangible assets is that they provide some type of exclusive right or some kind of privilege for the person who owns them. And normally they are required or acquired for normal use, right? So there are a couple, bless you, there are a couple of lifespans or useful life that intangibles have. You can either have limited life, you can have indefinite life, or you can just be amortized or expensed. So if it's limited life, what does that mean?
I mean, that do the movie.
That means there's a certain amount of years that is useful. If it has indefinite life, that means that it never, ever, ever goes out of use. And then amortization or expense mean that we have to allocate the cost of that asset. Now, the different types of intangible assets that you have, page 412 and 413. First thing is a patent. A patent is basically that exclusive right or that privilege that allows those who invent new things to protect them and use them. Okay? And a patent has a useful life of how long? 20 years. That's a long time, right? So the 20 years, are we considering that limited, indefinite, or expense? Limited. Okay, copyright. That's just the exclusive rights for those who make music, who develop or have art of some sort. Those are their exclusive rights to the things that they sell. And is there a useful life on there? So that means either that person's gonna die first, which is probably more than likely true, or if not, at least up to 70 years. So that means if that person dies at 65, the useful life is only 65 years. If that person dies at 70, then they've reached the max, right? Franchises and licenses. So what are we talking about when we say franchises and licenses?
Basically giving someone else the ability to use something that you created.
Right. So places like McDonald's, they have so many different locations, right?
Right.
Some of them are owned by franchise owners. Some of them are owned directly by McDonald's. Those that are owned by franchise owners do not have the right to go out and market McDonald's as their own company. They work for McDonald's. They own a piece of McDonald's, right? And they always have to represent the McDonald's name. They can't go out there and put McDonald's on t-shirts if McDonald's did not authorize for them to do that. Okay? What's the useful life for franchises and licenses?
The investment for potential for those costs of not,
Notice it said if.
Yeah.
It said if an agreement is for an indefinite. So that is totally up to places like McDonald's to say how long you can be a franchise owner or you can have that in place. Trademarks and trade names, that still goes back to McDonald's, their signature M, right? Coca-Cola with their signature logo. These are symbols or brands or logos that are used to market important products, right? And they have a useful life of how long? That's most definitely how long? Indefinite, right? McDonald's logo will always be McDonald's. Even if McDonald's went out of business tomorrow, nobody else can take that M and use it for anything else because it is indefinite to McDonald's. Okay? Goodwill. Now, this is something that you may not have heard about prior to now. But with goodwill, that is basically the amount of money that is in excess of the value of the company. So in other words, when companies acquire other companies, there's a certain amount of goodwill that goes along with that purchase. Okay? So think of a good example other than what they give in the book. Okay. the in the event companies like Walmart decide. Okay.
What about how Family Dollar bought Dollar Tree? And Dollar Tree bought Family Dollar. I know one bought the other.
I didn't know that.
One, I think Dollar Tree bought Family. I know.
I would imagine probably Dollar Tree bought.
I think they bought Family Dollar, but they allowed them to still continue use
their
their
name.
Family Dollar name, even though they're. I guess that's why Dollar Tree expanded like this because it's all.
Okay.
But one did buy out the other. I can't remember who bought who, but one bought out the other. Would that be simply something?
It is. I just don't know how much in goodwill they could possibly have. Another example, or more small scale, could be, I don't know if you guys recall the bank that used to be Washington Mutual.
Yeah, they got caught by
Wells Fargo.
They changed their name.
Wells Fargo.
Chase bought,
Wells Fargo.
Wells
Fargo wasn't
Fargo.
around. I'm watching the show out.
But even with that, if a larger company purchases a smaller company, and the smaller company that they purchase has more value than what the market value says their value should be, then you can consider that excess amount goodwill. In other words, if let's just say Walmart bought the Kmart's. If Kmart is worth 500,000 and you paid 400,000 for them, they have that 100,000 in goodwill.
And goodwill is just used, like it doesn't.
It just adds to the value of the company, because that goodwill could be composed of anything. That goodwill could say the market is saying that they're worth 500,000 because they have 50,000 more in useful assets that are going to last or extend beyond the next 10 years.
Like they building stuff, like you can tear them down to go renovate.
Right, because what happens if the building that they put the Kmart in was brand spanking new when they put them in there, and they were only in there about 6 months before they got acquired. That building still has a significant amount of value depending on the area, depending on the state, those types of things. So the excess money is to be put into a goodwill account and considered to be great value for that company. Leaseholds. So all that refers to is the whole leaser agreement. Person owns a property, they rent it out to someone, right? But even though they rent it out to someone, who ultimately holds the value of that property? The person who owns it. The person who owns it. So that's what that refers to. What's the useful life?
Time of the lease, right?
Like you had 1 year.
If we're talking about the useful life of the lease, that's going to depend on whatever the lease and the leaseor put into place. If we're talking about the useful life for the person who owns that property, that's going to be indefinite based on, how long the building lasts. However, you still have to amortize or expense the costs that come along with the rental property. So anything that has to be fixed, anything that has to be completely replaced, all of those things are considered to be expensed. Okay, so it is now 10:54. 15-minute break. When you come back, we're gonna go over some problems, and then I'm gonna let you go for the day. So 15 minutes. So that means you should come back about 11:10. Okay, so in your books, we should start on page 423. Quick study 10-2. So quick study 10-2. I believe it was 423. Okay, quick study 10-2. It says Keebler Bowling installs automatic scorekeeping equipment with an invoice cost of $190,000. The electrical work required for the installation costs $20,000. Additional costs are $4,000 for delivery and $13,700 for sales tax. During the installation, a component of the equipment is carelessly left on a lane and hit by the automatic lane cleaning machine. The cost of repairing the component is $1,850. What is the total recorded cost of the automatic scorekeeping equipment? So, if we had to truly
You wouldn't add in that 1850.
1850,
Yeah, you just add in all the other stuff.
right? And why would you not add the 1850?
Cause that's not part of the, actual cost of the equipment.
Okay,
I read it, I have to go back, like this
it's not a part of the acquisition, is it,
Right,
or the purchase?
it's your fault.
So, what was the cost originally,
$190,000.
and what else did we add to it?
The 20,000 for installation costs,
Uh-huh.
4,000 for delivery, 13,700 for sales tax.
4,000 for delivery and 13,700 for sales tax, which gives us a total cost of how much?
227,700.
227,700. Good. Now, the reason why we would record that 1850 is because it's not considered a normal or even reasonable expenditure. And the reason why we say it's not normal or not reasonable is because we really don't have to repair it in order for that equipment or that asset to be used, right? So that's why we can't consider it a normal cost. Good. Let's move on to quick study 10-3. On January 2nd, 2013, the Cerritos Band acquired sound equipment for concert performances at a cost of $65,800. The band estimates it will use this equipment for 4 years, during which time it anticipates performing about 200 concerts. It estimates that after 4 years, it can sell the equipment for $2,000. During year 2013, the band performed 45 concerts. Compute the year 2013 depreciation using the straight line method. So, before we even write numbers, what is the straight line equation?
Cost minus salvage divided by equal life.
So judging by that, what was our cost for this problem? 65,800. And did it have a salvage value?
2,000.
Minus 2,000. And then we're going to divide that by
4 years.
4 years. Useful life. What's that depreciation amount? So $15,950 per year. Good. Next one, quick study 10-4. I'm sorry, honey. Was that too fast?
Yeah, I'll write it down.
Y'all have to say something because otherwise,
You just wrote it.
I don't know. But all of this will be emailed to you, this PDF.
So let
So
me
whatever
ask
you
a
don't
question.
get, it's okay. Go ahead.
Did we answer that question? Because it says compute the year 2013 depreciation. Oh, never mind.
Yeah, it was.
I was trying to say compared. Sorry.
It's okay. 10 dash 4 quick study. Refer to the information in quick study 10 dash 3. Compute the year 2013 depreciation using the units of production. So what is the units of production equation?
45.
What's the equation though? Isn't it similar to a straight line? Cost minus what? Salvage value divided by what?
Unit of production.
Total units of production. In the case of this problem, and we're referring to the previous problem, we know that the cost still remains at 65,800, right?
Mm-hmm.
And the salvage value is still the same, correct? The only thing that has changed is what?
Total unit production.
So 65,800 minus that 2,000 salvage value. And instead of us using useful years, we are using units of production. How many units?
Okay, that's
How
what I
many
had questions.
concerts?
Will you use 45 because it says year 2013, but the whole total would be about 200.
Yeah, that's
So it's gonna
it.
be 45.
You just said it. The whole year is how much?
The whole 4 year?
245 concerts.
No.
Oh,
How many
All
all
in
in
all is 300 concerts.
How much do they anticipate to perform?
200.
200 concerts. Because remember, this part is just step one. So 200 concerts, right?
Right.
And this is step one. Step two would be what? Step two is for you to take the unit, the price per unit. Multiplied by units produced or units consumed. So what was this amount here? 65,800 minus 2,000 divided by 200 concerts. 319. And then taking that 319.
Why am I getting
319 times 45 concerts gives us how much? 14,355, and that is our depreciation amount for that year. Right? So good. Let's do something that is more going to take more thinking on your part, obviously. Go to page 424 in your book, and let's do let's do page 425, exercise 10-2. Page 425, exercise 10-2. It says, Callum Manufacturing purchases a large lot on which an old building is located as part of its plans to build a new plant. The negotiated purchase price is $280,000 for the lot plus $110,000 for the old building. The company pays $33,500 to tear down the old building and $47,000 to fill and level the lot. It also pays a total of $1,540,000 in construction costs. This amount consists of $1,452,200 for the new building and $87,800 for lighting and paving a parking area next to the building. Prepare a single journal entry to record these costs incurred by Calla, all of which are paid in cash. So the thing is, before we can start recording journal entries, what do we need to do? Find out what? Total cost, right? So the first set of costs that we need to do are what?
The land and the building.
You do them together?
Yeah, the negotiation prices need to both come together.
Okay. So if we gotta start with the cost of the land, what was the purchase price you paid? Purchase price was how much? $390,000.
Yeah.
Okay, and are y'all sure?
Don't you add the 280,000 plus the
That's the
lot?
purpose of us going through all these
Oh,
costs.
well, first it's 280,000 for just the actual land.
280,000 for just the purchase of the land. And then what other costs are included?
Plus 110,000 for the old building.
So old building costs 110,000. Okay. What's next? What else do you add?
The fact that they paid 33,500 to tear down the old building.
So demolition for the old building. Was how much? 33,500. And what other costs?
And 47,000 to fill and level the lot.
So fill and level the lot. 44,000.
47.
47,000. Are those all the costs that we need to include?
No, it also
No.
pays a total of 1,540,000 for purchase costs.
But
the amount breaks down to different things.
yeah, and we're just on the land right now. That's not considered to be a part of the land cost. That's considered to be a what? We talked about it. A land improvement.
Oh, yeah.
Those are two different things. So when we add all of this, the total cost of that land was how much? $280,000 plus 110,000 plus 33,500 plus 47,000.
407,500.
Now we need to do the cost for what?
Improvement.
Cost of the land.
The land improvements and what else? Did you buy a new building? Did you do a new building?
Oh, and paving.
So what's the first cost that I need to do for land improvement and new building? First of all, what was the cost of the new building?
There's 1,540,000. That's for the whole construction.
Cost of the new building.
Oh.
Yeah. Say it louder right here in the front. 1,452,000. That was a new building. And what were the land improvements? 87,800. So what was the total cost for the land improvement? $1,540,000. All right. Now we can do some journal entries. And how is this journal entry gonna go?
You would do a, debit.
Yes, it does. It does play a part.
So would you debit cash for the total cost?
Tell me. I already passed accounting too. Look at all the things that you have up here. I mean, what we calculated was the total cost of the land, right?
Mhm.
Then we also did land improvements and a new building, right? So those are really the three accounts that are involved other than cash. Land improvements, and the building. How are we gonna list it on our journal entry? Debit what, credit what?
You would debit land
Uh-huh.
for 28,
Debit land, debit what else?
debit old building, new building.
Debit building, because we washed that whole old building thing out. So debit land,
Debit building.
land, building, and what else? What else should you debit? Land improvements. And credit what?
Cash.
Cash. How much was land?
200.
Look up here.
470,500.
475. Building.
1 million.
1 million. 452,200. Isn't that what you have here? New building. Land improvement. 87,800. So that means cash is gonna total out to what?
1,540,000.
All these added together? It's way more than 1,540,000.
$2,010,500.
2,010,500. Everybody agree? Good. You said might as well, right? Somebody calculated it. Good. And just if I didn't mention it before, as long as you're in here, you're referred to as an accountant, which means if you think like an accountant, you do what accountants do. Accountants should always have calculators, always have a what? Pencil. Yes, pencil. And always have a load of scratch paper to write on. Okay? And always also have your book. It's important to have your book. Okay, so exercise 10-4, which deals with depreciation. Exercise 10-4. In early January 2013, New Tech purchases computing equipment of $154,000 to use in operating activities for the next 4 years. It estimates the equipment salvage value at $25,000. Prepare a table showing depreciation and book value for each of the 4 years, assuming straight line depreciation. So this is exercise 10-4. We're dealing with straight line depreciation. And don't worry, if you cannot get this right now, it is fine. This lecture will be uploaded today in Anchor. So you'll be able to watch it as many times as you want to. Knock yourself out. Okay? What's the equation for straight line?
Cost
Cost
minus salvage
minus salvage value
divided by
Useful life. Okay, so if we got to make a table for this particular problem, using this equation, let's find the depreciation out first. What was the cost in this case?
154,000.
So we got 154,000. Was there a salvage value?
25,000.
25,000 salvage value. And what were the useful amount of years? 4 years, which gives us depreciation of how much?
$32,250 a year.
$32,250 a year. So $32,250 a year. Now we got to show a depreciation schedule, right? And we got how many years to show for? 4 years. So you got year, depreciation amount, book value. Yeah, that's fine. We can go with that. What year did it start?
2013.
2013. So we'll go all the way up to 2016. Is it 4 years, right?
With the actual year.
Is it 17 or 16?
That's what I'm saying. You count the actual.
No, it's 16. It only depreciates for 4 years, not 5. Yeah, because this is being depreciated immediately.
Oh, okay.
So by then, purchasing something and depreciating taxes.
When was it purchased?
Oh, it says January.
Right. The only time you can't depreciate is if you bought it at the end of the year.
Okay.
But in this case, if they bought it in January, you got to depreciate it that year because 12 months would have passed.
Okay.
So, what was the annual depreciation amount?
32,000.
So every year we know that it's going to be depreciated $32,250. That doesn't change, right? Because it's straight line.
Right.
What I think I may do here, just so it makes sense, is do accumulated here and do book value so you know. So we started off with what book value?
154,000.
154.
That's what we're talking about.
Do you have salvage? How much did you start off with? So,
129. 129,000.
and when you subtract that 32,000,
Yeah, 96,750.
wait a minute. What did you start off with?
The actual cost or the cost subtract the salvation?
$129, right? Okay. So 129 would be our what amount?
129 is that?
Salvage. Is it 129 even?
Yeah.
All right, so ultimately we need to get back down to here, right? What's going to be the first year's book value?
121,750.
And tell everybody how you got that.
1,540 minus the 32,250.
But I thought we had the
121, 750. 154,000 minus 32,250, which was the first year of accumulated depreciation. And your question was probably going to be, well, I thought we had to subtract salvage.
Yeah, that's my.
We put it down here because we know we're working towards it.
Okay.
You can do it either way. It really doesn't matter. 121,750 next year is accumulated depreciation is how much?
89,000.
No. Accumulated depreciation. Meaning previous year's depreciation plus this current year's depreciation. 64,500, but the new book value amount is how much?
89,500.
What about 2015? What's the accumulated depreciation amount?
96,750.
So wait, you did 121 instead of taking minus 54,500? You did 89?
No. 121 minus 32,250 gives us our new book value. This amount is the 32,250 from the previous year, 32,250 for this year. Now we're here plus 32,250. What's our new book value? 89,500 minus 32,250. 57,250.
Yeah.
What's the new accumulated depreciation for 2016?
127,000.
Even. What's the new book value?
It's below the, no, it's not.
What is it?
25,000. 25,000.
Which got us where? What did we get back to?
The salvage. Oh, okay.
And then all of these added together equal that. All of these accumulated depreciation added together equal what? Is it? Are y'all just guessing, or are you telling me what you calculated?
I got 173,950.
All these.
96. Oh. 188,000.
You did the most important part with everything else. Ultimately, we got back down to, back down to the salvage value, right? One more problem, and then we're gonna go ahead and let you guys out. So you gotta make it a good one. Let's do exercise 10-5 because that deals with double declining. Exercise 10-5. Refer to the information in exercise 10-4. Prepare a table showing depreciation and book value for each of the 4 years, assuming double declining balance depreciation. So using that same information that you had before, what's the double declining equation? What's the steps?
100% divided by the life of years.
So step 1 is the 100% divided by useful years. Step 2 is to do what?
Multiply the straight line rate by 2.
Straight line rate needs to be multiplied by 2 to equal double rate, right? In this case, what was the useful amount of years? 4 years. So we have 100% divided by 4 years, which gives us what? 0.25. And then step 2, we're going to take our 25% and multiply by what?
25.
By 2 equals our double rate of 50%. So with our double rate, and we got 4 years we got to deal with, so that's 2013 through 2016. We care about beginning book value, then our double rate, and then our depreciation every year, and then ending book value. So beginning book value, depreciation rate. What else did I say?
Accumulated.
And then year end, right? Accumulated depreciation, and then year end book value for 2013, 2014, 2015, and 2016. So what's the beginning book value for 2013?
154,000.
154,000. What's the double rate? 50%. What's the accumulated depreciation?
332,000.
No, that was a straight line. We're on double declining now. What's your annual depreciation? Not accumulated, it should just say annual depreciation. That ain't in no book. Calculate it. 154,000 times 50%. What's your annual depreciation?
77,000.
77,000, which makes your ending book value how much? That's right. Say it with attitude. All right, 2014. We started out, we ended in 2013 with 77,000 book value, right? So that obviously means that's the beginning book value for 2014 times the same double rate, 50%, which gives us an annual depreciation of how much now?
38,500.
38,500. New book value.
38,500.
All right, now, are you yelling at me? You're getting it now. It all makes sense. So that's the new book value for 2015. 50% double rate. What's the annual depreciation?
19,000.
You sure? Calculate it again. Yeah, but what's the catch?
It's going up.
Say it. Say it. Say it.
Yeah,
Below the salary, which means we need to do.
it's it right there.
That's it. But it's not 19,000. What is it?
38,500. 32,250.
Oh, no, you in this 32,250. No, it's not 32,250.
The salary, but one salary, 25,000. Cause we using the information from the
First one.
Yeah, but what are you missing?
I was saying we just don't know.
And you're right, and it's not gonna go below. But what's missing?
the rate of the.
You just told me the salvage value was how much? 25,000. And you see the book value is at how much?
38,500.
25,000 subtracted from 38,500 gives us what?
13,500.
13,500.
Oh, because it can't depreciate more.
Right.
Okay.
So 13,500, that brings our book value down to what now? What is it?
25,000.
25,000, which also matches
The salary.
salvage value. So we stop right here. Right. So that means if they want to get anything left out of that asset, they will probably dispose of it for that 25,000 by year 3. That's what I mean by double declining being more accelerated. Now, if you add these up, what do you get? And what's that 129? You remember that number?
That was the depreciation.
Total.
The total minus 95.
Yeah.
Yeah.
Good. All right. Are you comfortable?
Yep.
One, two, people, kind of. Yeah, the homework is a totally different story, right? Totally different animal. All right. So, looking at your schedule, you have, what's today? The 19th. Your integrity ethics post is due when? Tomorrow night, 11:59 p.m. Learn Smart is due by 27. Which is next Wednesday. Homework is not due until the 31st. Next Wednesday, when you come in here, we're going to work more on Chapter 10 problems, more specifically what's on the homework. And also go over a little bit of Chapter 11. Because I see you on Tuesdays, you are expected to be in class next week. I know class is out Monday, but you have class will be on Tuesday, so you're expected to be. Everybody understands, right?
Yes.
Okay. Keep up with that schedule. Very, very, very important. And we will complete more problems next week. Okay. As far as roll is concerned,